value is starting to emerge in some areas that were deemed expensive, and people were throwing around the term, are we in a bubble, as recently as a month ago. And I think the air has largely come out of a lot of those bubbly names. The Oracles, the NVIDIAs, Meta and Microsoft, Palantir, these names had really they'd sort of gone parabolic for a short period of time. And I think that was just a sign of speculation that had infected the market a little bit. We were getting a lot of, not necessarily direct questions, but the sentiment was a little bit like, hey, could we be doing a little bit better? In spite of the fact that we're into year 3 of double-digit returns. And that always makes me raise my eyebrow a little bit when people, you can feel the greed from investors and just people that are talking to you generally, people that are maybe not even very sophisticated retail investors that are getting excited about these opportunities to double their money. Where am I seeing value today? I think you can start to buy some of these market leaders that were maybe getting falsely labeled as in a bubble, but have fallen 20, 25%. They've gotten much more buyable. And then also, just to address the previous video that we did, I think there's still plenty of value in some of those laggard industries and sectors like energy, materials. We also talked about healthcare. Healthcare is sort of started to almost become a new leader. And it's sort of followed the biotech trade. So there is definitely value here, which is so interesting because the conversations were very different 30 days ago. Things were getting a little too easy. And I remember feeling that way myself, that it was just getting a little bit too easy. The market was so calm. I don't want to say for no reason. I mean, there's all sorts of contributing factors, and flows is a big one, fund flows. When things start getting priced for perfection and it becomes sort of an inevitability that you put money into the market and it goes up. It goes up not just year over year, but we're talking about people were expecting to make money by the week. And I think that is definitely a sign that we've reached some sort of a tipping point. And it does feel, obviously hindsight will prove us correct or not, but it does feel like the bubble has been burst. And I don't mean that in a tech bubble, year 2000 type way, but maybe we just had a little bit of overvaluations that were happening in certain sectors and polluting the views of investors. Just seemed too easy. And I think there's been a little bit of a reckoning for certain types of investors who were, without realizing it, taking an enormous amount of risk. People really had gotten to a point where they were putting an inordinate amount of their portfolio into companies and stocks and crypto, things that they really couldn't even maybe explain. It seems like there's been a bit of a reckoning for those types of investors, which nobody likes to see people get hurt, but my humble opinion is that was needed. That was actually needed. The market needed to reset, and some of the froth needs to come out for the market to get a little healthier. I don't know where this term K-shaped economy started, but I do sort of like it. It's descriptive. People have heard the V-shaped recovery. The market goes down sharply and bounces right back sharply. A K-shaped economy sort of indicates that there are two legs or pieces to the economy, or factions, and one is sort of up and to the right, and one is down and to the right, which I think people can kind of feel, whether you're looking at the market or you're reading stories about how people are having a hard time buying homes, in affording groceries and things like that. Inflation is really affecting certain parts of the economy more than others. So the K-shaped economy is a very descriptive way of saying that we've got certain companies or sectors that are thriving right now and several that are languishing. And I think it's really as simple as that. And I think that's a problem if you're a policymaker, because you don't want unevenness in in terms of companies, but also consumers, who's participating in this economy if it is in fact growing. So I think what's happening is that we're starting to hear mention of this when the Fed talks and other policymakers talk. They're focusing on this lower part of the K, which are the areas that are struggling right now, which home builders and housing, anything related to that, materials, freight, shipping, these sorts of things. Obviously, tech is through the roof, and that's great. I mean, these companies are holding up the stock market, but we're seeing a lack of participation from some of these other areas, and those affect consumers and middle income and lower. It is fascinating that, and a little concerning even, that the odds of a rate cut went from 28% to 71% within one day. And what's changed is we had a minor sell-off yesterday. I know certain areas were affected more than others, but it was really pretty run-of-the-mill in terms of a bad day in the market. But also, you know, we've got the one speech from the Fed President Williams where all of a sudden the odds go, you know, through the roof overnight. Was it related to the sell-off yesterday? Was there some politics happening where let's come out and have a comment that's going to indicate that we're going to have a Fed cut coming soon? I don't know. There was also a positive news headline, or potentially positive news headline, that NVIDIA may be able to sell chips to China, and I think there was a little bit of an overhang about whether that was going to be something that gets put back on the table or not. It does feel like the market is sort of hanging on a couple different things. Like there's really, we're having to thread these needles. This week in particular, we had the NVIDIA earnings report, which I haven't seen that much attention paid to what an individual company had to say in a very long time. And the results were phenomenal. It was sort of even better than what the market was hoping for or feeling like it needed to hear. And then the market sold off the next day anyway. We sort of opened up and everybody was excited. Okay, we've got this AI trade is not over. In fact, it's far from over. But then the market sold off anyway, which generally speaking, it's not good news when the market, whether it's good news for the economy or good news for an individual stock or sector, and the market sells off on that news, that's generally not good. But then, 24 hours later, and now we're hanging on something else, which is the prospective rate cut. And who knows if the market sell-off yesterday had anything to do with it, but this morning we've got a new speech from New York Fed President John Williams that's indicating that the likelihood of a December rate cut, which had gone down to 28%, is now up to 71%. So now the market's sort of like, oh, we've got something else to potentially look forward to. So there's like a tug of war that's going on behind the scenes with investors. Where can we safely put money? Is this AI trade going to keep pushing, or do we need to start looking to other sectors that have previously been lagging? And I think this week may have been pivotal in that way. So funny enough, with the excitement around Bitcoin and cryptocurrencies seemed to be more so as it was gaining in price, and it was going up, and people were making money with it. I haven't seen, or we haven't been getting many inquiries about it now that the price is falling pretty dramatically. I think 32% from the high. No, we're not getting any questions or interest from people that are saying, oh, now we see value in Bitcoin. And I don't know if that tells us anything really. To me, it's a speculative asset. It's something that can be traded, and I don't necessarily fully understand the reason why it needs to exist, but it does, and it makes up over $1 trillion in market cap. The thing that I'm concerned about when it comes to a 32% fall in this asset class that is now pretty sizable is the potential risk of contagion. So far, we've seen the market absorb all of this. A third of Bitcoin's market cap being wiped out in a couple of weeks. The broader markets are down just a handful of percent, which is nothing to write home about. If Bitcoin were to get cut in half again from here, my concern is that the owners of Bitcoin, large institutional and retail investors that have millions and tens of millions of dollars invested there, if they're doing it on margin, where they start to get a margin call and they need to come up with cash to meet the margin call, does that start to affect other parts of the market? That is something that I'm concerned about. As somebody who's merely an observer of Bitcoin from the sidelines, that's my concern at the moment. But I think what could go right is sort of what's happening, which is some of this froth and speculation is coming out of the market. Because at some point, it becomes too extended. And this sort of goes back to maybe the first question that we talked about today, which, when things are just parabolic and greed is overrunning the market, to me, that's major cause for concern and also a sign that we've reached or are about to reach some sort of peak in the market. So the fact that this is, we're sort of being brought down to earth in terms of sentiment in the most speculative parts of the market, I think that is actually one way that the market can return to health. Not that it's unhealthy necessarily, but I do think excessive speculation is a sign of an unhealthy market. So I think we're sort of returning to a healthier place where we can kind of regain our footing and have some new leadership. And we talked about this on our last video. Tech can't be the only game in town forever. It's great that it's been there and it's bolstered us in a year where, we've had all sorts of trade and tariff issues. It's been terrific that it's sort of carried the market this far, but I think a really what could go right going forward is that new leadership emerges. And that doesn't mean that tech needs to fall apart from here, but it just means that other sectors are going to start to gain some traction. And again, I know we talked about it last time, but housing is an area to me that it doesn't get a lot of attention in terms of the stock market, but it's so big in terms of the wealth effect. And if people can start getting a little bit more excited about that the housing market and spending money on the house that they currently live in, the quote unquote real economy, the lower part of the K, I think it's not going to happen overnight. It's not going to be proven between now and our next video, but that's what could go right, is a reduction in speculation and an increase in real economy.